In this video, we'll explore how the plane crash impacted the markets and analyze investor behavior from a psychological perspective. The world was once again shocked by the crash of an Air India flight traveling from India to London. This tragedy, which claimed the lives of more than 240 people, shook not only the aviation industry but also the global financial system and human psychology. But such incidents don't just affect the moment, they reshape human behavior, economic decisions, and investment trends. Today, I'm going to tell you about the unseen psychological and financial dynamics behind major disasters like this. So, how can a plane crash lead to million-dollar market fluctuations, investor panic, and shifts in consumer behavior? The human brain is not resilient against uncertainty. That's why major accidents amplify not just the real danger, but the perceived danger. And the interesting part is that most of the time, this perception becomes more powerful than the actual risk. This is where the paradox of irrational rationality emerges. Everyone wants to act logically, but misinformation, media influence, and emotional reactions lead to decisions that seem rational, but are actually driven by emotion. This causes serious distortions in the reactions of both investors and consumers. Let's remember, after the Boeing 737 MAX crashes in 2019, Boeing's stock plummeted. Many countries banned the aircraft from flying. So what happened next? Just a few years passed, and the same planes returned to the skies. People got on them again, and investors bought the stocks once more. This reveals another psychological reality: the forgetting reflex. Losses, pain, and shock fade over time, and people tend to leave risks in the past. So on one hand, the mind says, this plane is dangerous. But on the other hand, it says, I have to fly anyway. And if everyone else is flying, I will too. Herd mentality clashes with individual risk perception. This contradiction is known in psychology as the rational denial paradox. Humans can knowingly walk into risk, because more often than not, habit outweighs caution. The same pattern applies to financial investors. When the plane crashed, Boeing stock took a huge hit, but institutional investors saw the drop as a buying opportunity. This leads to yet another paradox. Is it the illusion that opportunity arises from crisis, or just cold-blooded calculation? One person sells in panic, while another buys calmly. Yet both behaviors are rooted entirely in psychological instincts. After such crashes, companies spend millions trying to rebuild trust. Compensation is paid. PR campaigns are launched. But interestingly, while these steps may suppress the crisis in the short term, they leave long-term scars on brand perception. So, does everything get forgotten over time? Most of the time, yes, because people tend to focus on the future more than hold on to the past. This reveals another behavioral pattern we call the psychological cycle of forgetfulness. Major disasters like plane crashes actually expose the true nature of the economy and human psychology. Markets react not only to data but to fear, rumors, and uncertainty. And no matter how rational we think we are, our decisions are often shaped by emotion. In short, when a plane crashes, it's not just lives that are lost. Trust is shaken. Waves ripple through the markets. Insurance companies go on alert. Investors hesitate. And consumers are left with new fears buried in their subconscious. But then, everything seems to go back to normal. And maybe that illusion of returning to normal is the greatest paradox of all. What I wanted to show you in this video is this. Just like economic systems, the human mind is fragile. And some crashes don't just happen in the sky, they happen in the deepest layers of psychology,